Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to run through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions, generally related to wealth building, commodities, and or financial topics. So let's dive in. Let's take a look and see what people are sharing. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, where I dive deeper into these topics, subjects, I can answer your questions with my opinions during weekend question and answer sessions, or you can send them to me directly and I can answer them during the meeting. So coming on down, it says Isabel Net, wealth. Stock ownership in the United States is concentrated among the top 10% of Americans who own almost 90% of the stocks. I don't know if that's a good thing or a bad thing. I don't know if they're trying to make a statement by this, but that is the data, share of stock holdings by wealth. And I don't see how this would be any different. I mean, you're going to have people and personality traits that want to save and invest. And there's going to be a lot of people who don't have that, and that's going to be a reflection of the population to some degree. Coming down, unfortunately, so SRS Rocker Report. Unfortunately, global oil shale production continues to decline with approximately 240,000 barrels per day of global oil shale production. It represents a paltry 0.2% of the total global oil supply at 100 plus million barrels per day. Low energy investment, oil shale just isn't economical to produce at scale. So the total global oil shale production of 2021 actually has declined since 2018. So him, SRS Rocker Report, and Tom have been going back and forth. Tom says, "Oh, you mean this story about the 1.5 trillion barrels of recoverable oil from the USGS from 2011? FFS, get over yourself." As they're going back and forth. Um, I don't know what the answer is here necessarily. My opinion is you cannot confuse reserves with flow rates. That's like saying we've got an entire ocean full of water, and someone says, okay, well, we want to immediately convert ocean water to drinking water. We don't know how to do it, and we don't have any of the pipelines or anything really set up to do it to feed water to the middle of the United States and to the Middle East, let's say. And you're like, people will say, well, we've got all this water. There's not a water shortage. And you're like, yeah, but it's not drinkable water. And we have no way of getting that water somewhere else. So to argue a flow rate problem with reserves is not understanding the problem, in my opinion. Just because you have an abundance of something somewhere in the world doesn't mean that the entire world has an abundance of that thing. Coming down, we've got Charlie. It says monthly mortgage payment needed to buy the median priced home for sale in the United States. So April of 2020, it was 1480. And today, April of 2024, we're at 2890, a record high, basically a double. It's a 95% increase over the last 4 years. So homebuyer housing payments are up 14% year over year. That's actually quite a bit. And here's the thing. How come the housing market isn't crashing yet? Where is the inventory and where are all these inventory builds? I mean, we might be building to some degree in some areas in terms of inventory. Yes. And maybe we head back more towards a normal market with the affordability where it's at. But if you were to bring this affordability back to 2021, home prices would go ballistic, goose. So that's what's causing or slowing the housing market down is affordability. And that's the whole purpose of increasing interest rates is to slow bank lending, is to basically kill the inflation that's being created by credit. Doesn't mean you're going to get a crash, though. The U.S. consumers are feeling priced out of everything. And this is the University of Michigan buying conditions. Of course, the conditions are horrible. You've got high interest rates and you've got a bunch of people wanting to buy a bunch of crap. Your conditions are tight. And when they're tight, people don't feel good because it's uncomfortable and expensive. SRS Rock Report, you do realize the global annual natural decline rate is now north of 11 million barrels a day. It's lost each and every year. That has to be made up just to offset the declines. We start to head over the energy cliff circa 2025, running faster and faster just to keep the oil supply flat. So, in his opinion, and the data that he's got here, the decline rates of existing fields is 10.5 million barrels per year. What that means is that every single year we need to find greater than a Saudi Arabia to offset the depletions that we are seeing every single year. And at some point, we're not going to be able to find that amount of oil and increase our flow rates to basically offset the easy flow rates and declines of existing fields. That's the cheap, easy oil that we're trying to replace with very expensive, hard to get, and not very flowable oil. Technology will, I think, help us achieve perhaps more efficiency in oil extraction, but it does not impact the ultimate reserve. It may impact the recoverable reserve of it, but it has not shown, technology has not shown that we can reverse a declining field with technology alone. Coming on down, we've got Luke Roman during the breakdown of globalization 1.0 from 1900 to 1945 and much of the Cold War from 46 to 81. Bonds averaged negative real returns for 80 years. Why will it be different this time during Cold War 2.0 and the breakdown of globalization 2.0? So 2022 was a disaster for bonds, down about 30%. And there were huge stretches of periods where bonds returns were really negative. And he thinks that maybe that is what's coming ahead of us. 97% of us feel very uncomfortable. And this is the income a family needs to live comfortably in the United States. And these are some of the valuations. I'm in Colorado. It looks like one of the higher cost states, 265,000. 277,000 in California, 279. Now, I can tell you this, guys, from when I purchased my home and what I do, I have a family and it's probably bigger than most people's families. It's bigger than two children that are living. So I've got three, me, myself, and then I've got one stepson that lives with us too. And 265, I don't that's way higher than what I would say is living comfortably. But I also own my home and locked in my mortgage at a very low price. So I would say it's probably like less than 100. If you were to look at my expenses, it's probably less than 100 is my guess. And I feel like I'm living comfortably. B of A, the slope of the yield curve suggests volatility should pick up from here. Now, here's another thing that I kind of want to talk about and show you guys. It's an observation, obviously. So it says the slope of the yield curve suggests volatility should pick up from here. This is the VIX index, which is real low. When the VIX index goes up, that's generally when volatility goes up. You look at the 2 and 10-year spread. We had that 2 and 10-year spread start to decline in 0203. That's when commodities took off like no other. I think that's going to occur here, where it's going to drop. That is really, really good for commodities. You can see it wasn't that good here when we were going up there, but it was really, really good from 2020, which was this big move upward, and then the move lower. So I think we're coming to an area that might be okay for commodities here. U.S. oil rigs with changes in the key shale basins. Permian's down 2 rigs to 311. Eagle Ford's up 1, 49. Williston's unchanged. Canna Woodford up 1, and DJ unchanged at 9. So really, Not much change, no change at all, actually, if you take aggregate. Price action shows the entry point. The narrative is not the exit point, but it is always behind the curve. What does that mean? I get a lot of people asking me, why did this thing go down? Or why did this thing go up? Or they're looking for a reason of why something moved. And then they attribute a reason to it. My opinion is just doesn't matter. The narrative is always made up after the move. Sometimes it is accurate, sometimes it is not accurate. The question you should have is it would be like this. Let's say I'm going to bet on somebody who's going to sprint down the road. And there's a couple of things that I could do to prepare myself for guessing when the sprint could occur. And what I did is I hid a sensor underneath the person's foot to see how much pressure they're applying to the foot. So if someone were to say, do you think that person, when do you think they're going to run? I'll say, well, when the pressure spikes and they start to put more pressure into their foot, they're going to run faster, is my guess. So I look for that pressure in the system, or not in the system, the pressure for the foot. And I'm looking at the sensor, I see that sensor and the pressure go, and I say, he's going to run right now, bam. And then everyone else asks, well, why did he run? Why is he running? I'm like, I don't have that data, guys. All I have the data of is the pressure coming to the buying or the selling, and what that looks like in terms of technical analysis and the potential market conditions. We don't know what the reasons are behind a lot of the short-term price action movements. No one can attribute it, and they just make up stuff in the news so that people can be satisfied with it. It's just made up. So you can't use news for anything. One, the news is too late. You lost your entry point already. And two, the news doesn't matter because it's made up anyway. The big structural market moves are the things that interest me. So we've got preview here, got miners. The Huey performance 24 months after last Fed rate hike. So this is the red here is the 2023 to 2025, and you can see the performance of gold and silver mining companies, and they all went higher over time based off of 2000 to 2002, 2018 to 2020, 2006 to 2008, and 08 2023 to 08 2025. Jesse says gold is valuable not just as a tradable commodity, but because it knows things about the future which are useful. One of the things that gold knows is what crude oil prices are going to do, and basically what it does is front run it. So red is crude oil, and then near month gold futures shifted 19.8 months forward. And what he's saying is we have about a 20-month gap between oil moving up, or sorry, gold moving up first and oil lagging behind it. So if you were to shift the curve 19.8 months, it lines up with the price of oil almost perfectly. And what this suggests is that the recent price action in gold, when it started moving, I think it was October of 2022, if you add about 20 months to October of 2022, that is when you would expect oil to work its way on up. So that's kind of the predictive nature of precious metals versus crude oil, and the money working its way through the system. It takes about 12 to 24 months is the average-ish. Here it's 19.8 months is what he's got. Oops, wrong way. So Tavi, let's go into this thread here. The most critical question facing investors in the precious metals sector today. If this truly marks the inception of a new secular bull cycle for gold, why are the junior miners significantly lagging? And here is silver, gold, the physical metals. We've got the senior miners that are keeping pace, and we've got the junior miners down here lagging behind it. So let's get Tavi's opinion on the junior miners and why they might be lagging. He says, in my opinion, the answer can be distilled into two primary points. This is a common phenomenon, and the lag is your friend. Initially, funds typically gravitate towards larger and more liquid companies before investors begin seeking higher returns in riskier market segments. And number two, following numerous failed attempts, investors are understandably disillusioned with trying to time the market bottom and are now understandably skeptical about the prospects of this industry. The reality is that market participants tend to fall into the trap of believing that this time will be different. Hence, the lingering question remains. Are we truly witnessing the onset of another global gold cycle? I strongly stand with that view, and here are the main reasons why he stands with that view. Central banks still allocate less than 20% of their balance sheet to gold relative to the 75% peak observed in the early 1980s. And you can see this big roundish bottom going on. And a lot of people are probably wondering, well, why would banks buy gold? Well, maybe because they distrust each other and they can't invest it in bonds. So what they do is they start to accumulate more gold because of the distrust between each other and the system itself. It says traditional 60-40 portfolios are only beginning to redefine their allocations to incorporate hard assets like gold. The valuation history of 60-40 portfolios unfolds through extended cycles, and we are currently experiencing another critical juncture in this dynamic. The earning yield cycle of 60-40 portfolios, and this is before the 1901, prior to the Great Depression, historically overvalued, and this is the overvaluation of the 60-40 portfolio. And what this is, he says the 60% weight of the S&P 500 earnings yield, inverted CAPE ratio, and 40% weight of the US Treasury 10-year yield. And we're in a very overvalued area for that 60-40 portfolio and the S&P 500 earning yields. It says this is the first time in 45 years that gold has become less volatile than treasuries. In other words, treasuries are no longer the safest alternative. And look at gold coming up first time in 45 years for the 7-year rolling monthly downside volatility differential against treasuries. With deglobalization trends on the rise, there arises a necessity for sovereign institutions to own neutral assets. They can't be buying each other's bonds because of the distrust. So they're putting it in gold. Gold supply is currently at its most restricted, with the quality of reserves deteriorating. The average grade for gold reserves by the top 10 miners in the world has been in a secular decline. So these are the top 10 gold miners, average grade for existing gold reserves, continuing to head lower and lower over time. And this is why I like the physical metal so much. It's getting harder and harder to get out of the ground. And I think it's going to get more energy intensive. You have to move more tons of earth to get the same amount of pounds of whatever you want. Precious metals production continues to fall, mirroring previous long-term cycles. I agree with this one too. This was a downward move in terms of global gold production. Every single time we get these big bull markets, we peaked here earlier, early 2020, I would say, we were peaking and heading lower. And that's when gold price really took off in each one of these big gold bull markets. Here's another one. There have been almost no new discoveries of gold, resulting in the depletion of existing resources. It says here's an older chart from Cuscat Kevin, which remains the case still. Gold discoveries greater than 2 million ounces, millions of troy ounces, and really we haven't discovered any big discoveries of gold. This is occurring across all of the commodities in the world. We are depleting what we know of good reserves in the entire world across a whole bunch of different commodities. And I have a feeling this is going to get very expensive for all these different commodities. Tavi says capital expenditure trends for mining companies are currently at historically low levels, despite efforts towards reshoring, manufacturing revamp, and the green revolution. Metals and mining industries aggregate capex continues to go down against GDP. Stubborn inflationary pressures are priming investors to once again favor hard assets as a portfolio allocation. This, to me, is the three waves back in the 70s and 80s of inflation. And he thinks we are right at the bottom of like early 70s, in his opinion. Reckless fiscal spending and the dearth of monetary discipline are compelling investors to seek alternatives beyond government-backed securities. So U.S. twin deficits to GDP is declining, much like the 2000, the later 2000s. We had a big move in 2020. This list could be expanded further, but I'll keep it relatively concise. If you ask me, we could witness gold prices soaring to unprecedented stupid levels in the coming decade, as these long-term imbalances inevitably exert significant upward pressure on the metal. And then he's got this: junior miners have yet to emerge as an exceptional opportunity. In my opinion, as a wave of M&A comes, along with speculation, is poised to unlock the potential of this segment of the industry that has long been overlooked. And this is GDXJ versus GDX, and it's just starting to break out of its downtrend line. Looks really good. Rolling it there for that. Coming down, we've got Mike Zaccardi. He says, B of A commodities are better 40 than treasury bonds going back to the 1940s. So if you had a 60-40 portfolio with commodities and skip the treasuries, you'd have a greater return since the 1940s till today. This one says, can I please ask, what's your most amazing wow factor on the global energy transition? Javier says that global coal demand will rise to a record high in 2024. Explain that on a dinner with friends from outside the energy sector, and you will see several quietly reaching for their smartphones to Google your claim in disbelief. We've got gold miners hitting new 52-week highs. That's something you don't see too often from all-star charts. This is the Wisdom Gold Mines, WDOFF, working its way on up. And GDX also 52-week new highs. Looking good, feeling good. Gavin says, interesting housing update from Redfin. The number of listings with price drops increased sharply in April to 6.2% and is tracking significantly ahead of the last 3 years. Guys, I think this was just the wrong data to track. That's fine if listings had price drops, but maybe people are just too overly aggressive with their initial releases. I would see that as under an increasing price environment. They're too bullish and they've been going up and up and up. When people get depressed at like a bottom, that's when people start fighting over the homes. So tough to use this data for much of anything, in my opinion. And then RevCap, in response to that, he says, slightly different picture below. Sellers just have crazy expectations because the Fed is cutting. And agents are convincing sellers to list homes by putting out crazy asks. This is also with mortgage rates at 7.7%. Mortgage rates are coming down again with the 10-year. So that's what's crazy is it's the balance of their asking price and what people can afford and the demand out there. Not a bad point. What do you think? It says, I need someone to explain to me why it's always, if you can't pay rent, buy fewer lattes and avocado toasts. And not, if you can't pay your employees a living wage, buy fewer yachts, rockets, and spacecrafts. Explain it to me like I'm in kindergarten. Okay. Well, I'll start with this. The owners of businesses are the ones that make the decisions. They're taking the risk. They are the ones that make the decisions. You as an employee do not make those decisions. You are not taking on those risks. So if you're not taking on the risks and you're not making the decisions, they are, then my opinion is you're not going to see an owner bankrupt their company or take fewer profits if they're putting up all the capital and taking on all the risk. So you can try to pay people more on the market, but the market really determines what people get paid. It's not necessarily the employer. So there could be very good workers that the employer wants to retain, and maybe they pay those workers more money. But I find it very difficult for someone who is 20 to 30 years old, just graduated college or high school, and they're coming out of high school or college, and they get to determine their own pay. If they're not taking on the risk of opening up their own, their own business, taking on a loan, finding capital, then why should they have that much power? You're at the whim of everyone else, and that's what this feels like. You're coming from a place of weakness because we've got all these people who don't have a lot of money coming out of, younger people, we'll call it. They are hungry to get moving, and they'll take not that much money for a job to get experience and whatnot. I don't see how that changes. I mean, to have an expectation that you're not worth much on the market and then expect everyone to pay you a bunch of money, that just sounds stupid. It sounds like you're disconnected from the real world. As the world becomes more technologically advanced, I think that pay will go down because you're also competing against everyone in the world. It's not just America. You're competing against everyone because you can work over the internet. So you got to find something that you're an owner of and that you can get away from people who own you. I mean, that's really what it comes down to. Here's the world total oil consumption continuing to go from left to right. It doesn't look like it's slowing down yet. Here's yesterday. The COMEX had 174 silver deliveries. London had 665 deliveries. The derivative product was high at 1,360. Do we break $30 this month or even today? Do we break 50 soon? Does the COMEX claim force majeure due to the upcoming false flag? Buckle up in terms of the silver squeeze, and deliveries keep draining the COMEX. We've got the Great Marti says market fractured, stagflation intensifying, Fed flip-flopping narrative has caused significant dislocations. Books will be written on this, and that's all of these big moves from yesterday. So I'm gonna end it there, guys. We've got a thought, give me a thought for the content. Subscribe to the channel. Subscribe to the website if you'd like. We got the question and answer session going on right now. So if you want to join, go ahead and join, and we'll see you on the call there. So that's what I've got for today, guys. We'll catch you later. This is Finding Value.